Welcome back to Newsfeed PM. Let's get into some business now. The South African Reserve Bank may have cut rates by 25 basis points last month, but consumers are still feeling the effects of higher repayment rates. The latest Altron FinTech Household Resilience Index shows that South African households continue to suffer under elevated rates. The index indicates that the 15-year high interest rates have meant households were stretched to pay for houses, cars and loans. 2 years ago, households spent around 6.7% of their disposable incomes to pay off debts. This ratio has since increased by 36%. The report says consumers are now spending 9.1% of their income on debt. We're now joined by Dr Roelof Botha, who compiled the index for Altron FinTech. Dr Roelof Botha, compiling this particular index, what were some of the fragilities that you're seeing in South African households currently?
Yes, the biggest single concern is certainly one that you've just mentioned, 9.1% of disposable income, when it was only 7.6%, I believe, not long ago, 6.7% in fact. If that ratio had stayed the same, in other words, if households had only been paying 6.7% instead of 9.1% on their disposable income of disposable on debt, then they would have had, since the Reserve Bank rising cycle began, they would have had more than 170 billion rand to spend in shops, perhaps also to complement a potential deposit for buying a house. We see that the Better Bond index of home loan applications is also down. The drive.co.za index for the motor sector is always also down compared to where it was a couple of months ago. I personally believe that the Monetary Policy Committee waited too long to start reducing interest rates, and they should have done a lot better than this measly 25 basis points.
And of course, consumers during the period, at least the past 2 years, have been faced with incomes that have faced high inflation, those higher interest rates. How would that have played into the spending of the households?
Well, the very frustrating issue here is that the inflation rate, in fact, is not South Africa. This is not our biggest problem. Our biggest problem, and I believe most viewers would agree with me, is unemployment. We need to create jobs in this country. The inflation rate has been in the Reserve Bank's target range for the past 18 months. That's a year and a half. There was absolutely no reason to raise interest rates to significantly higher, 175 basis points higher than it was before COVID. And it was too high then, because there's no demand inflation in this economy. And the spike in inflation was not caused by demand factors. It was caused by the 700% increase in global freight shipping charges and the 400% increase in Brent crude oil. And that has come down. Both of them have come down. So inflation would have been lower today, more or less at the same level, possibly even lower, if they had not raised interest rates by such extent. All they did was decimate demand in this economy and prevent it from growing at a higher rate.
And how aggressively do you think the SARB should cut going forward?
Well, quite frankly, if you look at the, I think viewers would have noticed that our long-term interest rate, the benchmark there is the 10-year bond yield, has now declined from its high in April, end of April, by 200 basis points. And there is a positive relationship between long and short-term interest rates. This effectively means that the prime rate, which is now 11.5%, should be 9.5%. And if I'd been governor, it would be 9%, because we desperately need employment creation in this country.